Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we take a look at how the economy is faring in 2017 and ask why you should care about environment, social and governance concerns when investing. Let's dive straight in for our first interview. Emma Wall, Senior Editor for Morningstar.co.uk, speaks with Keith Wade, Chief Economist for Schroders, about the outlook for global economic growth and what threatens expansion.
Hello, Keith.
Hi.
So we've had a report out this week from the IMF about global growth. Let's start with the good news, because there was some in the report, wasn't there?
Well, certainly, because the IMF have upgraded their outlook for the world economy, which is always excellent news. Now, some of that isn't a surprise because, in a way, the IMF are catching up with their previous forecast, which was back in the spring. But the data has been very good. And actually, recently, we've seen, if anything, a bit of an acceleration in the world economy, with a lot of the business surveys coming in a bit stronger than expected and suggesting that the world economy is really finishing 2017 on a very strong note.
It certainly puts to bed concerns about this, of us having already peaked with the global economy and global economic growth and going into a recession period, doesn't it?
Well, it certainly has. And I think also the talk of secular stagnation as well, that's really sort of gone away at the moment. And what's particularly encouraging about the recovery at the moment, it does seem that business investment is beginning to pick up. So the recovery now is sort of broadening out into a business investment phase, which is extremely encouraging for future growth as well.
That is the global outlook, however. Looking closer to home at the domestic economy, the UK GDP growth, that was downgraded, wasn't it?
Yes, I mean, that's disappointing because, of course, in a strong world economy, you'd expect the UK to be benefiting. And it's doubly disappointing in the sense that the pound has fallen very sharply. So the UK would have been expected to have been able to take advantage of this. My view is that the Brexit effect is probably weighing on activity, particularly on trade, because a lot of our partners overseas are not sure about what our future trading relationships are going to be. And so that the weak pound has not translated into stronger growth.
It has translated into a higher stock market, however, though. So once again, proving that economics and corporates are not necessarily intertwined.
No, that's right. I mean, of course, a large proportion, about 60-70% of UK earnings are from overseas. And the UK equity market is very international. I mean, it's a bit more exposed to all parts of the world, including the emerging markets. And it's quite commodity and energy related, so it tends to move on a different path to the economy itself.
Now, there was one line in the IMF's report which I thought was rather interesting, and it was about the disillusionment with globalisation and the impact this could have on future economic growth. We've seen the election of Trump, we've seen Brexit here in the UK, and that certainly plays that anti-globalisation message. But we've also seen across Europe it failed to sort of build up speed. Le Pen did not get in France. Yes. The Dutch elections did not go the way of anti-globalisation. How concerned should we be about anti-globalisation and its impact on the global economy?
Well, it's interesting because so far this year, actually, the news has been quite good, particularly the election of President Macron in France. But of course, recently with Catalonia, we've seen an example of nationalist sentiment, regional sentiment emerging. I think the fundamental problem here is that although the world economy is doing better, we're not really seeing that translate into stronger wage growth. So households generally are not sharing in the improvement in economic activity. And given the increase in inequality that we've seen as well, this has caused a lot of discontent. And of course, this is what's been behind the rise of a lot of populism that we've seen, particularly in the US and UK. But I don't think it's the end of the story. And until we start to see stronger productivity growth and stronger wages coming through, I think this kind of populist sentiment is going to continue. And people then will be looking at anti-globalization measures such as protectionism or breaking away from a group or what have you. So I think fundamentally, the economics of anti-globalization are probably still there. And this is one reason why the IMF has said, we need to use this opportunity of stronger growth to try and improve productivity, try and improve education and so on in order to get around that.
Keith, thank you very much.
Thank you.
With construction data looking weak and UK GDP forecast downgraded, should you be worried about the impact of slow growth on your portfolio? To discuss, we have up next Tim Graf, Head of Macro Strategy for EMEA for State Street.
Hello, Tim.
Morning.
So we've had some data this week, PMI data, which suggests that the UK economy is not perhaps as robust as we might like it. How should we interpret this kind of data?
I think we should interpret it as being another sluggish Q3, or another sluggish quarter, I should say, continuing on the sluggish performance of Q1 and Q2. So it's going to make it very difficult for the growth forecast of the Bank of England to be met if this data is sustained in the hard economic data for Q3, which I think is a real challenge given they're talking about rate hikes coming up.
And are we just being too pessimistic? Because if we cast our minds back a year ago, we were very much expecting to be in recession by now. The Brexit referendum had happened. You know, the negative Nancys of this world thought that we would be, you know, with a crashing market and a recession. And that's not the case. We do still have positive growth. So should we be worried?
I think so, because a lot of that growth has come off the back of a very resilient UK consumer who's been able to sustain demand largely through the growth in consumer credit. Credit levels aren't worrying yet, but they might well be, particularly if interest rates are to start rising. So I think even though we've done a lot better than a lot of forecasts going into the Brexit vote, that is maybe, I think, missing some of the broader picture, which is that the UK economy is still somewhat fragile and very dependent on easy monetary conditions, I think.
And of course, if interest rates rise, that will hit households. It'll hit them in terms of mortgages, in loans, in credit cards. What about in terms of their investments? How does, rising rates and a sluggish economy impact portfolios?
I think it's going to still be very difficult. I mean, we've heard about how rate rises will be decent for savers, but we're not talking about long-term programmatic rises in interest rates. We're talking about maybe 25, 50 basis points. So savers won't necessarily be helped that much, particularly given how high inflation is. So I think fixed income investing in the UK, particularly for domestic investors, remains very, very challenging. Real rates, especially long-term real rates, are likely to remain negative for a good period of time. The equity markets actually might fare a little bit better because I think sterling will probably remain weak for some time. Given how much of the FTSE is internationally focused, that will probably be to the benefit of corporate earnings for the big large cap UK companies. Small caps may fare a little bit more difficult.
And of course, we are having this economic, the stilted economic growth because there is uncertainty in the market. Should we then expect the economic growth to remain at these kind of levels or even dip, given so much of Brexit is still uncertain?
I think these kind of levels are probably the baseline scenario. I don't think there's going to be a disaster coming up, that we have about as much political uncertainty as you can fathom right now in the UK economy to deal with. And the UK economy is dealing with it, albeit in quite stagnant fashion. So I wouldn't necessarily look for a downturn from here, but I think relative to the rest of the world, we're having this pickup in growth in almost synchronized fashion around the world, and it's not really happening here. So I think it will continue to lose ground on a relative basis, even if in absolute terms it probably fares okay.
Tim, thank you very much.
Thank you.
Economic growth may be downgraded and UK politics may be in turmoil, but Britain's chief executives remain positive, explains Phil Harris, manager of the EdenTree UK Equity Growth Fund, up next.
Hi, Phil.
Hello.
So a lot going on in the UK
Busy
at
times.
the moment. Economically, we seem to be not doing as well as hoped, with a couple of forecasts being downgraded. And indeed, politically, there is a significant turmoil, not least around the future of our Prime Minister. As a UK equity investor, how much does this sort of turmoil play into what you do?
It does very much so. I mean, I think it's fair to say that at the start of the year, we thought the UK economy was a little bit stronger than it was going to be. There clearly has been a little bit of uncertainty, not just Brexit, but clearly the general election over the summer has meant there's been a little bit of a slowdown in consumer spending. It's interesting, though, if you go out and talk to companies, the chief executives, although there's huge uncertainty over Brexit, actually, when you talk about individual companies, they're still pretty confident. So if you ask a chief executive and he'll moan at you about what's going on, the next question must be, therefore, you must be cutting your capex, you must be doing other things. Oh, no, they'll say, actually, things are very strong and my individual businesses are doing very well. So although there is that uncertainty on both the consumer and the investment front, actually things are reasonably good at the background. There has been a bit of a temporary slowdown. A little bit of that's the inflation that's coming through, but we're reasonably positive going forward into next year that things will turn around quite quickly.
And why is it that chief executives are positive? I presume it's because not all of the stocks that you invest in, or not all the chief executives that you talk to, are wholly domestically focused?
No, that's absolutely correct. So a large percentage of the earnings for sort of UK PLC are overseas. So about 60 to 70% generally of overseas earnings are there. So companies very much are talking about, the European economies, which is very strong, Asia, which remains very strong, and obviously the US as well. So although there's a domestic focus to many companies, they are looking more globally. They're still seeing interest rates very low. They're still seeing inflation very low, and a general backdrop that's quite favourable. So they're sort of riding through any particular UK problems and looking more generally.
And what about the UK consumer? Because we are an economy that is built very much on consumer spending. Consumer confidence may well take a hit with Brexit. Is consumer spending a metric that you consider when looking at investment?
Very much so. And I think also it's not just the overall level of consumer spending, but it's actually how people spend their pound. So if you look at things like big ticket items like cars or sofas or big sort of purchases like that, the consumer is relatively cautious at the moment with a limited amount of money. Wage growth is very anemic. We've all got a job. Unemployment's very low. But actually, if you're in a job, you have very little wage growth, perhaps 2.5%, inflation nearer 3%. So what you're looking to do is to target your pound onto something. And what are people doing? They are still going out for their coffees. They're still buying their Domino's pizzas. They're still buying those low-ticket items. And also they want their holidays. So they're allocating that pound perhaps, rationally into the things they want and deferring other things they don't. And that does drive our investment process. So we avoid motor retailers, high-ticket consumer stocks, and look at low-ticket consumer stocks, Domino's pizzas, we mentioned, Patisserie Valerie. So yes, very much that sort of thing does drive our investment process.
Phil, thank you very much.
Thank you.
The further markets climb, the fewer gains there are to be had. Morningstar investment manager Mike Coop says investors should be cautious and prepare your portfolio for turbulence.
Hi, Mike.
Hi, Emma.
So we're here today to talk about risk, but I think before we get into the risks that are in the market, we should talk about the market itself. So year to date, set the scene. Where are we now?
Things are still pretty buoyant, The last month hasn't been quite so racy, but most markets are up double digits on equities. Bonds have done okay. It's really only been commodities and probably linkers that haven't done that well. So pretty good by and large. And we haven't had a material sell-off this year, unlike most other years. Volatility's been pretty low. I think investors are still feeling pretty good about things.
I think that point, though, is key in that, unlike other years, the last 5 years, there hasn't been a significant drawdown in markets, which means for you, as value-based investors, this is getting quite a difficult market to invest in, isn't it?
Yes. We use valuation as our guide to both return and risk over the long term. And what's happening is that there are fewer and fewer markets that are trading at or below fair value in the long run. So the challenge really is, you have to fossick pretty hard to find things. So it basically means, unfortunately, lower returns for investors. And the challenge is this is also happening at a time when things are becoming less supportive. We have, believe it or not, interest rates have actually been going up for quite a while. And we're now seeing the rollback of some of the quantitative easing programs. So it throws some challenges up for investors.
And where have you been adding recently? Because you're saying it's much more difficult to find value-driven investment opportunities. Where have you been looking?
We've had to dig into sectors and individual countries. So Russian equities has been a market that is still very lowly priced. They've been through recession. The earnings profile is good enough to offer you a pretty good return given the current valuation. European telecoms is another out of favour sector. But you know what, Emma, it's been really tough finding things, and we're really at a point now where there's hardly anything that really offers good value. Whereas 12, 18 months ago, there was a lot more assets, and a lot more of the emerging market complex would have fitted into that category.
OK, well, we don't want to end this video on such a low note. What should investors do given this much lower return forecast and given the fact that it is just so much harder to find any good value opportunities?
Yeah, I think investors have got two choices. You either just push on for return, accept the higher risks that you face, or you decide that, in fact, it's not worth taking on a lot more risk for a little bit of extra return. You give up a little bit of return, and what you end up with is a bit of firepower for buying assets when they become cheaper, and you reduce the risk. And that's really what we've decided to do, the reward for risk is generally not attractive. It's become increasingly less attractive. And for the long-term investor, this is not the time to be taking a lot of risk.
So basically, get more cautious, focus on capital preservation. And does cash have a part to play in all of that?
I think it does. I mean, cash, is boring, returns are low. People go, why have we got cash? It gives us optionality. It means when markets fall, we can buy them. It's also not a bad place to stick your money when everything else is expensive. It means you don't have to buy things when they're expensive.
And diversification is key as well, isn't it?
Diversification is key, and that's really tricky at the moment, is to think hard about what you're exposed to and the things that offset some of those risks. And so there are parts of the fixed income market that are starting to offer a bit better value for that, but you have to be particularly careful about the mixture of assets you hold.
Mike, thank you very much.
My pleasure.
When we make investments, financial return is of course very important to us, but it also is important to consider the impact such investments may have on our world. Sustainable investing considers environmental, social and governance factors when going about trying to make financial gains. Environmental issues could be the impact the company has on the environment, or how it's trying to improve the environment with, for example, renewable energy. Social factors include how a company deals with issues such as how fairly it treats and pays its workers, or whether partners and suppliers have similar values to their own. And finally, governance issues encompasses how well the whole organisation is run from a board level. Is the company accurate and transparent in its financial affairs? Is the company behaving fairly to its shareholders and allowing them to vote on important issues? Or is the company at risk to bribery or corruption? Many people have this belief that investing sustainably in this way will lead to inferior returns, but Peter Michaelis, Head of Sustainable Investing for Lion Trust, is up next to tell us why this is not always the case and that investors do not have to choose between ethics and profits.
Hello, Peter.
Morning.
So I thought we could start with a back to basics question, which is, what does sustainable investing mean to you?
Yeah. So sustainable investing is quite straightforward. It aims to deliver superior investment returns by investing in more sustainable companies.
And sustainable companies are much more far-reaching a concept than perhaps what many people think of as this type of investment, which is dark green ethical. Sustainable is much more open and encompassing rather than exclusionary, isn't it?
Definitely. So ethical and sustainable investing really has three elements to it. There is the sort of avoidance of controversial industries, which is within there, but it's evolved. And the second element within sustainable investing is around positively investing in certain areas, such as environmental technology, healthcare, renewable energy, high growth, long-term trends within the economy. And the third element around sustainable investing is engagement with companies. So modern-day sustainable funds encompass all three of those elements.
And why do those three elements lead to sustainable returns for investors? Because I think sometimes there is this idea that you have to choose between your sort of morals and profits.
Yes, definitely. People have that in their head, that in some way you're giving up returns. In fact, the very opposite seems to be true, and many sustainable investment funds are in the top quartile and outperforming their peer group averages. Now, the reason why it works as an investment strategy is twofold. The first is it invests behind these structural long-term trends within the economy, such as resource efficiency, energy efficiency. These are very dependable, positive, powerful trends. Companies exposed to those will do well. They will see longer-term growth prospects, and that is underappreciated by most investors. The second element is looking at companies more broadly in terms of their environmental, social and governance performance. And that helps you avoid things like Dieselgate and the impact on Volkswagen, BP Macondo in terms of health and safety accidents, Tesco misstating reports and accounts, or the PPI mis-selling. All of those things could have been identified ahead of time by looking more broadly at how companies perform on environmental, social and governance metrics. So that really leads you to a set of companies with stronger growth prospects and better quality management.
Is it fair to say then, as a sustainable investor, that you are perhaps more activist than somebody who doesn't employ those guiding metrics to their stock picking?
We are definitely active The active share of our funds is 90% in most of our sort of equity funds. So we're definitely not benchmark huggers. And so, we're trying to find those companies that are going to be the real successes of tomorrow, whether that's in the food industry, where there's massive change going on in terms of us changing our diet, whether it's in sort of changes in energy efficiency that are going on, which is driving huge demand for energy efficiency products, whether it's variable speed motors or thermal insulation, or in healthcare, where we look at innovation within healthcare and diagnostic companies. And these are all companies which are industry leaders, but are going to see very strong long-term growth while delivering a really positive product to their customers.
And would you ever help sway a company that perhaps was not quite there in terms of their sustainable, the ESG element?
Yeah, so clearly environmental, social and governance metrics are not as well developed as financial metrics. So we often engage with companies to say we'd like more disclosure on your energy efficiency, on your carbon dioxide emissions, or how you're managing your supply chains, because this information helps us to compare companies better to improve the investment outcome.
Peter, thank you very much.
Thank you.
Can an ESG fund hold energy and tobacco stocks? JP Morgan's Joanna Crompton is up next to explain her best-in-class approach to sustainable investing and why all companies should be ESG compliable.
Hello, Joanna.
Hi.
So what does sustainable investing mean to you?
So for us at JP Morgan, sustainable investing is considering environmental, social and governance factors as part of your investment process. So if you think about it, these are things that you should be considering in your analysis already. You can't sustain your profits into the long run. You can't be a good company to invest in if you are destroying the environment you need to produce your products, if you aren't managing your workforce correctly, or if you have a governance system that it leaves you open to corruption, for example.
And what about within the fund? Because I know that you take a slightly more concentrated stance, don't you?
So the Europe Sustainable Equity Fund is slightly different to how we view ESG across the firm. Across the firm, we're looking for ESG integration, which is consideration of and systematic and explicit consideration of ESG throughout your investment process. This fund is kind of the next step beyond that, so we're actually targeting positive exposure to ESG.
And does that mean that you find there are sector biases within the fund? Because presumably certain types of companies do this better than others.
So we've got a positive best-in-class approach, which means that we're looking for the sustainability leaders within each sector. So, for example, so we're not indiscriminately screening out large sectors or areas of the market. We can invest in tobacco stocks if we think they're sustainable and if we think they're a good investment. For example, in the mining sector, we'll own those companies that have an eye on the future and are adapting their business to increase regulation, etc. in the future. And we won't own those that are sort of more old school in their thinking, put it that way.
And what about the data? Because this is great from a theoretical point of view. I mean, why wouldn't someone want to invest in those types of companies? But does the data stack up?
So in terms of performance, what we found looking into the numbers is that that incorporating ESG into your process doesn't disrupt the alpha generation that we have from our behavioural finance process, which is the area in which I work. In fact, if you look at it more from a risk perspective, it's a very good way of managing your risks. So from a risk perspective, I'd say it's definitely additive to the process.
And when you're making an investment decision, at what point does the ESG factor come in? Because you can think about a company that may score very highly on ESG, but are they incredibly, expensive on valuations or another metric which makes them sort of less attractive?
So the point of this fund and the process which we use to invest is it's combining sustainability with our style characteristics that we look at, so value, quality and momentum. And the point of it is it's not just a screen at any stage. It's throughout the stock selection process, throughout our ideas for the fund. So what I mean by that is, ESG issues aren't existential for the bottom line of a company. We like, for example, Iberdrola, because the falling price of renewables means that utilities have to increase their exposure to renewables just to keep their market share, or if they want to gain market share. So Iberdrola is very well placed for that. So for them, sustainability isn't some existential issue, it's fundamental to their bottom line. So, you have to be aware of that, but at the same time, it has to be the right time to invest. Lots of solar companies that were exposed to these trends went bust. So you have to be at the same time aware of the fundamental factors, be aware of the value, quality, momentum, the style characteristics that we look at before you invest in the company.
Joanna, thank you very much.
Thank you.
Our final guest on today's podcast is ESG investor Camilla Ritchie, who runs the 7IM Sustainable Balance Fund. Camilla explains why she is upping her exposure to cash and alternatives as stocks and bonds start to look expensive.
Hello, Camilla.
Hello, Emma.
So why is sustainable investing the right way to invest?
Well, I think it is the right way to invest because I think we should be looking at the environment, we should be good to people, social terms, and the things we invest in should be governed well. So that's very important. But I think what's also very important is that our clients who are invested in our fund should get a very good long-term performance from their fund because they give their money to us. And it may be money for pensions. The capital needs to be protected and it needs to perform well. So that is key, and it has been the case because this fund has been around for more than 10 years. I can say that it has actually performed very well and has outperformed its sector that it's relative to, and that's not the sector. That's not a sustainable sector. That is a sector comparing it with all the other funds in the balanced risk profile.
And I think
that's really important, I think.
Yeah, that is key because I think there is a view sometimes that people have to choose between ethics and profits. And what you're saying actually is that you can have both.
Well, I think so, yes.
And what then about the ESG elements? I know that this is very different depending on the different fund, is interpreted in different ways. Sometimes there are negative screens, sometimes there are positive screens. I know there are certain sectors that you will not invest in. What are they?
Yeah, so I do have some exclusions, and they are in the sort of things that people might expect. So they're in weapons, nuclear, pornography, and a number of others. That's the exclusion bit. And you could say the dark green negative screening. And then on the other side, we do the positive screening, which is to look for companies which are doing good. So we screen for environmental, social, and governance, and look for companies which are doing good things in those areas. So I feel that the fund is doing things on making sure it doesn't have the bad things, but also making sure it has the good things.
And on top of that, of course, there is the very important part of what you do, which is the asset allocation, because this is a multi-asset fund. At the moment, where do you feel, in which asset class are the most compelling investment opportunities? Because we are in a slightly interesting passe where both bonds and equities look rather expensive.
Indeed, yes. And we discuss this at our asset allocation meetings, which we have every quarter, and that's when we do our major changes in portfolios. And we've just had one of those meetings. And in fact, for the last few meetings, we've been saying that we think that equity markets look very toppy. And but also bonds, so, as you said, which makes life very difficult. But we do have something else that we can use. We invest in alternatives, and they are relatively uncorrelated with both equities and bonds, which means that if equities and bonds are looking a bit volatile, you hopefully will get your return from the alternatives coming through, and that will make your overall fund a little less volatile than it might be if you just had equities and bonds.
Is this also perhaps a time for holding on to some cash in the view that because there are the two major asset classes are looking so expensive, or do you find that the alternatives is diversification enough?
No, we are actually holding quite an amount of cash. Also because we think that if there hasn't been a setback in the market for a very long time, if we were to see a setback of more than 10% or so, it might give you the opportunity to get back into the market. And if you don't have cash sitting there, then you wouldn't be able to do that. So we are using cash in that way. I mean, some people would say that cash is a bad thing to have at these sort of times because the return from cash is extremely low. But I think it's the opportunity cost of not having cash, which is maybe a bit more important at the moment.
Camilla, thank you very much.
Thank you, Emma.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.